One of my investment objectives is to generate weekly cash flow into my brokerage accounts. In my blog, I frequently have snapshots of dividend and interest payments received in one or more brokerage accounts on a single day. Longtime readers are familiar with that practice of mine. The cash flow is generated by a wide range of securities that include corporate and municipal bonds, CDs, U.S. Treasuries, common and preferred stocks, and closed-end investment companies, which I'm about to discuss. I'm going to abbreviate that phrase to CEF. I'm only going to discuss CEFs in this video as a generator of cash flow into my brokerage accounts. A CEF is a fund that has a fixed capitalization and trades like a stock on the stock exchange. As a result of trading like a stock, purchases and sales are not made at net asset value per share, which is the case for mutual funds, but at whatever price a willing buyer and seller agree to throughout the trading day. While this sometimes results in a buyer paying a premium to net asset value, the most common result is that the fund sells at a discount to net asset value. Information about CEFs can be found at the website operated by the Naveen investment firm, which can be found at cefconnect.com, all running together. For those unfamiliar with this security, more can be learned about them by clicking the Education Center tab at that website. The SEC Edgar website has the reports that are required to be filed by CEFs as a publicly traded entity. I have been trading CEFs since the early 1980s. My first purchase was in the shares of Adams Express, that has a symbol then as now of ADX, that is now called Adams Diversified Equity. This CEF was formed shortly before the 1929 crash in the stock market and the subsequent depression. The fund survived those events. That fund and many others pay dividends quarterly. Most of the dividend from ADX will be a capital gain distribution that is paid in the fourth quarter. I had mentioned recently in posts that I'm now attempting to increase my monthly cash flow from dividends into one of my brokerage accounts. I mentioned Fidelity, by increasing my purchases of CEFs that pay dividends monthly until I reach $200 per month in just that account. Those CEFs include both equity, balanced, and leveraged bond CEFs. The leveraged bond funds were hit hard in 2022 and most of 2023, since the abrupt rise in interest rates caused the bonds owned by those funds to go down in value. And the rise in short-term interest rates caused a spike in their borrowing cost, which for most of the leveraged CEFs is at a spread to a short-term rate like SOFR, SOFR, which replaced the LIBOR rates. Borrowing money to buy more securities going down in value is not a prescription for investment success, and is only made worse when the borrowing costs are going up, wiping out, in many cases, the spread between the yield of the security bought with borrowed money and the yield of the borrowed funds. Maybe, and only God knows the answer, the worst may be over for the leveraged bond fund CEFs. That assumes a bond rally that started late last year continues and the Fed starts cutting the federal funds rate later this year, which would lower borrowing cost. Examples of leveraged bond CEFs that I own include those with symbols BTZ, BHK, ERC, and NMMT. In the balanced CEF category, I have been buying CEFs like THQ and MEGI. I will recently I will discuss a recent elimination of a duplicate position in THQ in one taxable account while keeping shares in another one. A stock like GDV, a stock CEF like GDV, pays monthly dividends. They are also leveraged CEFs that invest in convertible securities. An example would be AVK, which I own. Those familiar with my blog, which started in 2008, know that I'm constantly trading securities to implement one of several risk reduction techniques that I'm now using. Frequently, I will sell my highest cost shares in a CEF, when I can do so profitably, which lowers my average cost per share and increases my dividend yield. I may eliminate a position even when some shares can only be sold at a loss, but the entire position was liquidated at a profit. The goal with high-yielding leveraged CEFs is to generate a positive total return in excess of the dividend before any return of capital adjustments to the tax cost basis. A ROC, which is an abbreviation I'm using for return of capital, adjustment lowers the tax cost basis by the amount of the dividend classified as return of capital. The ROC portion is not classified as a dividend income in the year paid. The amount will become taxable as a capital gain when the security is sold at a higher price than the adjusted tax cost basis. To avoid double counting in determining whether a purchase achieved my goal, I have to sell the shares at a price in excess of the original purchase amount when the cost basis has been reduced by a ROC adjustment.